Shares of Artemis Gold are down today after an unplanned mill shutdown that temporarily reduced output at the company's flagship Blackwater operation. However, the CEO has said that Artemis remains well positioned to meet its full-year production and cost guidance. So let's bring in Stephen Dean, founder and executive chair at Artemis Gold. It's great to have you join us. Thanks so much.
Hi, Lindsay. Good to be on the program.
So you've highlighted strong margins and cash flow despite that issue with the ball mill gearbox kind of failure earlier this year. What did that incident reveal, do you think, about the resilience or kind of vulnerabilities within Artemis?
Oh, it's the mining industry, Lindsay. That's very unusual for a gearbox like that to fail. It was only down for 5 or 6 days. So it's sort of maybe overstating it to say that it was a big problem, but it certainly impacted several days of production. We otherwise were pretty much on guidance and right down the middle of the fairway in terms of our cost guidance as well as our production guidance.
Yeah, because your production guidance unchanged despite this. I take your point. Like it was, I read 7 days, but it was only down for a few days. Did the unplanned mill shutdown also factor into your all-in sustaining costs rising, though?
Yeah, a small amount, because when you calculate that, Lindsay, you divide it by the number of ounces produced. So if you're a few ounces shy, then your cost will go up slightly because you've got the same fixed cost over less ounces.
Okay, let's go on to gold prices now. They've been pretty strong. You also delivered ounces into hedge programs at much lower prices than the spot market. How do you think about the trade-off between protecting downside risk and limiting upside exposure during a gold rally like what we're seeing?
Yeah, look, our hedging is an extremely modest amount. We have resources in the ground of almost 12 million ounces, and we've got something of the order of just under 300,000 ounces in total. And they'll be delivered over the next several years. So it's a very, very small percentage of our hedging. We did deliver quite a few ounces in this Q1 that were scheduled that way. We take the view that, particularly in price environments like we're enjoying right now, that we take our medicine. That they were extraordinary prices when they were put in place 2 or 3 years ago, and it's easier to say in hindsight that they look a little lower today compared to today's gold price. But I think the point that I'd like to make on behalf of the management is, we still maintain probably the industry leading margin in terms of the difference between our revenue and our costs. Our margins were just over $2,000 an ounce, which is about a 66 or 67% gross profit margin, which in any business is an extraordinary outcome.
Artemis also moving aggressively on expansion projects, also introducing a dividend. How do you kind of balance those two things, like rewarding shareholders while at the same time investing into long-term growth?
Dividend, good question. I think it's all about capital allocation, and we're showing that the business is ready to provide capital allocation outside of its capital expansion plans, and we expect to start paying those dividends in the second half of this year, notwithstanding the fact that we are increasing in the next 2 quarters our production by about 33%, and by 2028 we expect to be increasing or tripling our throughput and processing capacity, and exceeding more than 500,000 ounces of production on an annual run rate, which would make us one of the largest gold mines in Canada.
Let's talk a little bit more about the Blackwater mine now, because you're expanding into phase 2 for that mine. It's been named a priority major project by British Columbia. What does that do, that designation, in practical terms, in terms of like actually giving Artemis, timelines, permitting? Does that do anything for the phase 2 project?
It certainly gets us the attention of the various departments of government, particularly provincially, obviously. Priorities on power, for example, we're going to need a lot more power. We've asked the government for that, and we expect in the coming weeks that the government will commit to providing us with that additional energy, about 50 or 60 additional megawatts of power, which will help support the operation of EP2 once it's in operation. So it's those sorts of things that really help us by having the project designated the way they have.
Okay, and production, we talked about this, expected to grow quite a bit by roughly 165% between 2025 and 2029. What do you see as the biggest execution risk when it comes to scaling the business up that quickly?
Well, expansion and development of any mining project, wherever it is in the world, is always a challenging thing. We are fortunate that we've just only last year commissioned the first build of the project after about 2 years of production, of construction, I should say. And so we've got the same team who executed on that on budget and on schedule, doing our current expansion. So we've got the best chance, I think, of anybody in the industry to achieve our schedule and our budget. But having said that, it's not an easy thing to do, but the team is really good at it.
Okay, we're going to have to leave it there. We're out of time. Stephen Dean, founder and executive chair at Artemis Gold. Appreciate you joining us today. Thanks so much.
Thanks, Lindsay.